Hi, this is Mike Keeler. I'm a certified financial planner with GFS and Associates. And this is a presentation we gave to our clients a little while ago. I thought it'd be interesting to put it up on the internet so our clients who could not attend our event can see it and pass it on to anybody else who would be interested in it. So this is planning for 2014. It's a year of change. So tonight we're going to be talking about some historical facts, an overview of critical tax law changes, other key areas to watch in 2014, strategies to consider, and we go over some questions and answers. Now there are always 5 key areas to financial planning. We first start off with protection. That's your insurance program. Make sure you have enough auto insurance, homeowners insurance, life insurance. Your retirement plan. Make sure you can retire when you want. We talk about your investments, tax planning, and estate planning. This is mainly going to be covering some tax planning issues. Now, in 2013, both the Federal Reserve and the IRS celebrated their 100th birthday. Did you send them a birthday card? I just sent them a check. So, money supply, this is kind of interesting. The Federal Reserve in 2010 created $970 million. But to put that in perspective, $30 billion of monopoly money is printed annually. Now, not everybody is a good saver. According to Gallup, among people surveyed, 51.3% of Americans considered themselves thriving, 45.1% said that they are struggling, and 3.6% say that they're suffering. And according to a study by Harvard professor David Weiss and his colleagues, 46.1% of Americans die with less than $10,000 in assets, which means one of two things. Either they are brilliant spending the last dollar on the day they die, or, they're just not good savers. Now, volatility is not a new concept. Since 1928, the Dow Jones has increased more than 10% in a single day 8 times and declined more than 10% in a single day 4 times. And it's gone up either up or down more than 5% in a single day 136 times. Now, since 1928, the S&P 500 has closed at an all-time high 1,024 times, or 4.8% of all trading days. Now, a lot of people wonder where the name blue chip stocks comes from, and it actually comes from poker, where the blue chips are among the most valuable chips out there. So it means the stocks that have the largest and most consistently profitables. So that's a great place to put money often. Are interest rates low? Well, according to history, they're kind of average right now. We had some big spikes in the 1980s, but if you look at Japan, Japan has been struggling with low interest rates for quite a few years now. Tax history, the first income tax was in 1404 in England, thanks to King Henry IV. Now, our U.S. tax history, this is kind of interesting. The total pages of federal tax rules started off with 400 pages of tax rules in 1913, and in 2003 we were at over 54,000, almost 55,000 pages of federal tax rules. Now, who creates that? It's not the IRS, it's Congress. Congress creates the U.S. tax code. The IRS they're just in charge of enforcing it. So don't blame the IRS for this. You can blame Congress. The first 1040 form appeared in 1914, and it was only 3 pages long. Today, one estimate puts the federal tax code at more than 70,000 pages. How in the world can anybody understand that? Many of the tax law changes from 2014 are actually going to be showing up here in 2014. So we've got a new tax bracket. Thanks to 2013, we got a new top tax bracket that will be used on all returns filed on or before April 15 of 2014. The top ordinary income rate in 2012 was 35%, but in 2013 it's going to be 39.6%. And it's also going to be that on investment income too. There is a rise in long-term capital gains rates. Back in 2012, the top capital gain rate was 2012 was 15%, and in 2013 it is 20%. So hopefully you took advantage of that back in 2012. Now let's talk about estate, gift, and the GST, generation skipping tax. The top tax rate is up to 40% from 35% on estates. The applicable exclusion amount is $5.3 million for 2014. So that means a couple who properly plans can pass on over $10 million to the heirs. And that's good news because we saw all those articles about people losing the family farms when a new generation takes over because they can't afford to pay the taxes. The portability has been made permanent and the generation skipping tax provisions have been extended. Payroll tax have come back from vacation. Now from 2011 and 2012 we got a little break on our payroll tax. We didn't have to pay as much into Social Security. I thought that was kind of a goofy thing. Social Security's broke, so let's pay less into it. That didn't make sense to me, but whatever. So now we're back up to paying 6.2%, and of course your employer matches that on the first $113,700 you earn. Now if you're lucky enough to be self-employed, you get to pay 12.4%. Now there's a new healthcare surtax that began January 1 of 2013. Isn't that fun? A 0.9% healthcare tax on earnings. So if you're in the higher income brackets there, for single taxpayers it's $200,000 and above. Married, filing jointly, $250,000 and above. Hey, there's that marriage penalty again. Thank you so much, Uncle Sam. New Medicare surtax. In order to pay for all our new healthcare plans, we're going to have to pay some more taxes here. So how does that work? Well, there's a 3.8 Medicare surtax. Now there's a threshold amount. That's a key factor in the formula for purposes of calculating this surtax. For single taxpayers, it's $200,000. For married taxpayers filing jointly, it's $250,000. And of course, for estates and trust, it's just under $12,000. So those people who want to keep mom and dad's trust around just for old times, boy, it can actually cost you a lot of money. Some other tax law changes. Penalties for failure to comply with individual health care mandate. If you don't have your health insurance, you're going to get dinged. This year, it's not too bad. I think it's a couple $100, but it's going to be going up over the next few years. And some people may actually get a tax credit for buying health insurance. Now, there unfortunately are some tax breaks that expire in 2013. Unfortunately, here's the first one, is one that's near and dear to us here in Nevada, the option to deduct state and local sales tax. Since we don't have an income tax, we have been given the option to deduct state and local sales tax. This is one that seems to be put back in every single year. And Harry Reid, if you're out there listening to us, hey, go get that one back for us, okay? I know you can do it. Deduction for higher education tuition and related fees. Charitable donations from IRAs. Oh, the charities love this one. Maybe that one will come back too. You could donate money from your IRA and the charity would pay no tax. So if you donated $100,000 to your alma mater, they would get actually $100,000. They wouldn't have to give some of that to Uncle Sam. There were energy efficient home credits and a whopping $250 deduction for teacher paid school expenses. So all that paper and school supplies that they end up buying. I know my wife was a teacher. She spent thousands of dollars and got to deduct $250. Whoopee. But hey, it's better than a poke in the eye with a sharp stick. So who pays all of the tax? In 1986, the top 1% of all earners reported 11% of all the income, and then they paid 26% of all the income taxes. The lower earning 50% made 17% of the income and paid 6% of the nation's tax bill. Now we can see here in 2011, the top 1% earned 18.7% of all the income and paid 35.1% of the tax. And the bottom 50 earned 11.5% of the income and paid less than 3% of all the tax. So this may have made your head spin, but 2014 provides you with an opportunity to review your situation. Tax planning can be confusing. There are a lot of different options. What do you do there? The only constant we have with tax planning is change. And I like to refer it to the AAFA FEA. That's called the Accountants, Attorneys, and Financial Advisor Full Employment Act. By all these changes, it keeps me busy and makes my clients depend on me. So all tax changes do require planning. Hopefully you've gained some ideas here, some things that you can do. We go over a lot of this stuff with our different clients here. Hey, 2013 was definitely a tale of two different returns. Stock market was awesome, almost 30%, but the bond index, ouch, it got hammered, minus 2.13%. Pretty scary. A lot of people ask me, what do you see for 2014? And unfortunately, my crystal ball's in the shop. So what I do is I look at some of the experts out there. Up at the top, we've got David Bianco at Deutsche Bank. He thinks that the S&P will be at 0.2%. And then down at the bottom, Thomas Lee from JP Morgan, he thinks this is going to be a killer year, 12.3%. So if you average, yeah, we're looking around 6%. So I'm happy with a 6% return. That's better than inflation and better than some of these other roller coaster rides we've had. Now, a lot of people are concerned about their portfolio not making the same amount of money as the stock market. Now, you have to remember that the S&P or the Dow Jones, those are indices. That's not a measure of your portfolio. It's a measure of those particular stocks. And it's not what your portfolio, it's really what you need to consider is what your portfolio is doing, not what the market is doing. Now, for example, a lot of our retired clients, we don't want to be all in the stock market. You don't want to be riding that roller coaster. And that's a huge upset stomach sometimes. So your money is not going to grow as much as the stock market. So your portfolio won't move in lockstep with any single market or index. Why? Because you are not invested in that index. It's actually impossible to invest in an index. You can invest in an index fund, which works like an index, but it is not just like the index here. Now, another concern is about interest rates. I think everybody can pretty much guess interest rates are only going to go up. When? We don't know. But the big problem there is, as interest rates go up, bond prices go down. So you want to make sure that you've really shortened the duration of your portfolio, and we've been doing that for our clients lately. So what should you do for 2014? First of all, you want to review all your different sources of income. Some income you have control over. Things like dividends, interest. Your pension, you don't have control over it. That's going to just happen one way or another. So you want to review your different sources of income, maybe change how your income is coming in. There are a lot of different options that you have access to: retirement planning, gifting, beneficiary planning, trust, tax deferral. Look at these, see how they may actually benefit you. We've been looking at this for a lot of clients, the Roth IRA conversion. Sometimes it makes sense to do either a full or a partial Roth IRA conversion. Now, this is something that we really have to calculate on an individual basis, so if you're interested in this, please give us a ring. A lot of different alternatives out there. You can look at tax advantage investments, inherited IRAs, tax exempt, tax loss or gains harvesting. If you've got some things that have lost money, maybe you can sell them and offset some of your gains there. Roth IRA conversions, trusts, a lot of different things there. So what do you need to do? Maybe you need to analyze your sources of income and true cash flow requirements. Review your overall tax planning strategies. Reevaluate your investment goals. And reevaluate your investment timelines. Oh, by the way, we do have some interesting software that can help you define your investment goals. So give us a call if you're interested in that. And then finally, reevaluate your risk tolerance and review your emergency fund needs. We've been recommending all our clients increase money that they have access to in case of an emergency. Now, this is a great quote. Markets can remain irrational longer than you can remain solvent. That's John Maynard Keynes, a famous economist. And here's a great one from the Oracle of Omaha. If the past history was all there was to the investment game, the richest people would be librarians. Isn't that true? So, hey, we're always reviewing changes for our clients on a regular basis. So what can you expect from us? Constant communication, more frequent discussions, And we're constantly reviewing economic, tax, estate, and investment issues for our clients. I'm going to be going on at least 6 or 7 different conferences around the country learning about all these different things. So we've got a lot of challenges out there, and I've got to keep up to date on that. Our role as your advisor, not going to be making any panicky decisions. If you see the stock market go down 200 points, Mike isn't going to be panicking. We're going to maintain a non-emotional objective. Unfortunately, people get very emotional about their money, and that's where we see a lot of problems. However, this is where the casinos make all their money because people get emotional about their money. We're going to avoid those knee-jerk reactions. And we're going to assist you in making the decisions that are always in your best interest. And we're going to be here for you. Here's a great picture. I've got your back. I've been in physical therapy since I tore my ACL. And they had this picture of a spine there, so I couldn't resist that. Available today. Hopefully most of you have received our tax report. I hope it's been very valuable to you. And coming soon is going to be our next quarterly economic report. So help us help others. If you've got friends, family who might be interested in our newsletters, hey, sign them up. You can call up our number and say, hey, I'd like to put my brother-in-law or my friend so-and-so on your newsletter. We always put out some very interesting information. And finally, I'd like to thank you for giving us the opportunity to serve you with your financial needs. We don't forget why we're in business, and we're in business because of our clients, and we're very thankful for each and every one of our clients. And then finally, follow us on Facebook. You can look up GFS and Associates. We post a lot of information there, and I thank everybody for watching this presentation. I hope it's been valuable. I think we'll do more of these in the future because not everybody can attend our meetings, and a lot of our clients are across the country. So have a great day, and I will talk to you soon.